Multifamily real estate investing is probably the best investment class out there. Yeah, I said it, the best. It has the highest level of returns on a risk mitigated basis. If there's a better investment out there, I'd like to know about it. Let me know in the comments below. Now, in today's video, we're gonna break down the 4 main ways that multifamily real estate gets you, the investor, paid. Welcome back to the channel. I'm Dr. Jonny Walker. I'm a successful endodontist with multiple practices, as well as a self-made multimillionaire in real estate investing. On this channel, we teach dentists and busy professionals how they too can achieve true financial freedom through passive investment in real estate. We help you become an educated investor so that you can make wise and prudent decisions on your journey without the costly real estate mistakes, headaches, nightmares. And now, before we get into it, tell me a little bit about yourself. Have you invested passively in real estate before? Let me know a little bit about your experience. I'd love to continue this conversation in the comments below. All right, guys, let's get started. The 4 different sources of returns for multifamily real estate investors. Number 1, cash income. This is also known as passive income. When people talk about getting streams of passive income, or they talk about mailbox money, this is what they're talking about. Why? Because when you have a multifamily syndication or apartment building syndication, you, the investor, are not the one responsible for doing the work. That is the job of the general partner or the sponsorship team. And as a result, profits generated from the property flows in the form of passive cash flow that literally goes into your bank account without you doing the work. Now, where does this cash come from? It comes from the gross income from the property, which is rent, storage fees, application fees, late fees, pet fees, registration fees. When you add up all the income that comes from the property, called the gross operating income, and you subtract away all of the expenses, the taxes, the insurance, the utilities, the human resource, staffing, whatever is left over is called cash flow or cash income. And that will flow to the investors. Now, it depends on what type of asset class as to the type of cash flow returns that you might get. Now, we here at Walk of Wealth, we love to invest in Class B and Class C apartment buildings with 100 units or more. Now, the reason we like that is because there's a great recession resilient component to it. Now, in terms of cash, what kind of cash flow should you expect from a Class B value add asset? Early on, the cash flow might be in the range of 5 to 8% of your invested income. And then slowly, as we renovate units and we add value to the property and drive the income up, then the cash flows later on in that same Class B value add asset can increase up to 10 to 12% of return on income. So if, for example, if you invest $100,000 in a 145 unit apartment building, at the beginning, you might expect to get 4 to 5 to 6% cash on cash flow. Meaning if you invested $100,000, 6% means you should expect to get about $6,000 per year of cash flow. But as the rents go up in value add, and this is the beauty of value add, is the cash flow could increase up to 10 to 12%. So now that 100,000 might be paying off $11,000 a year versus $5,000 or $6,000 a year early on in the investment process. Number 2, we're gonna talk about appreciation. Now, appreciation does not mean having gratitude for something. Okay, that one didn't work. But appreciation is where the real magic in real estate happens. It is the biggest and most exciting way to create long-term wealth. Now, there's 2 main types of appreciation. There's market and there's forced appreciation. Market appreciation is the result of increases in population, jobs, and an imbalance of demand versus supply of apartment units. If you have a lot of people that are moving to an area because there's a lot of jobs and they're competing for living in a finite amount of apartment units, what happens is rents go up, and as a result, the value of the property goes up. And that's called market appreciation. This is completely dependent on the market forces of supply and demand. The second type of appreciation is called forced appreciation. In fact, forced appreciation is such a big part of what we do with Class B value add assets. Now, to talk about appreciation in a very compressed sort of way, forced appreciation, on the other hand, is not so much dependent on what's happening out in the market, which we're not in control of. The beauty of forced appreciation is we can actually control this growth in value. Now, how do we do that? You take the existing net operating income in a Class B value add asset. This is what we're currently getting as income. And you try to increase that net operating income, which in turn, as a multiple of cap rate, increases the value of the property. Now, there's two main ways that apartment building owners or operators can force appreciation. One is by increasing income, or the second part is decreasing expenses. Both of those have a result of increasing your net income, right? So for example, any improvements to the property, right? You go and renovate units, you improve the exterior of the property, you add a dog walk, you add a place for kids to play, a park. All of these things add value to the property, which as a result allows us to charge higher rents. If you charge higher rents, that means a higher net income. A higher net income means a higher valuation. So that's an example of increasing income. Another way is to reduce expenses. This also increases forced appreciation. So that might be just small changes to the management. Maybe decreasing the bad debt. Maybe decreasing the loss to lease. Maybe decreasing vacancy. These are all different. Introducing RUBS, ratio utility billing services, where you start charging the tenants for a portion of their utilities used. All of these things are in our control, and if we execute on this, it doesn't matter what's happening at the market at large, we still get the value driven up. That's forced appreciation. So forced appreciation is a beautiful thing. I mean, just by increasing the rent $25 on 100 apartment building units at a 6% cap rates means that we have increased the value by $2 million to the property value. So you can see how small changes in multifamily real estate can result in very large changes in creating long-term wealth. Investor money-making way number 3 for multifamily real estate. That is principal pay down. Now, remember, with multifamily real estate, just like most other real estate, it's a leveraged investment, meaning that we go out and we obtain a loan in the form of debt. Now, usually, if we are making mortgage payments to the bank and there is a principal and interest component to it, we're not, obviously this doesn't include interest only terms of repayment on a mortgage, but if we are making payments, mortgage payments, and a percentage of that is going towards paying the bank interest, but also a portion of it goes towards paying the loan back. So now every month, the amount of money that we owe to the bank goes down a little bit. Every month it goes down a little bit more, 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 a little bit more. But that means on a sale, what we owe to the bank is here, not here. The difference between these two is called principal pay down. And that is paid off by the income from your tenants. So you borrow the money from the bank, you take rent from the tenants and pay the bank back with their money. Sounds like a good way to make money, right? And when you owe the bank less money, that means you put more money in your pocket. All right, point number 4, last one for the day, guys, is tax benefits. Now, the tax benefits of multifamily real estate are very many. This is a very big topic. And I'm not a CPA, I'm not a tax attorney, I'm not a tax expert, and I'm gonna keep this very high level. But multifamily real estate is the most tax advantaged real estate investment. And correct me if I'm wrong, it is the most tax advantaged investment, period. And for any dentist and busy professional, the biggest expense that we'll ever pay is taxes. So learning about how to reduce our tax liability increases our personal net income, right? So investing in multifamily real estate has 2 main ones that I'm going to talk about. One is depreciation. Now, depreciation is a tax deduction that the IRS allows an apartment building owners to receive. This benefit also transcends to multifamily real estate investors. They get all the benefits of tax depreciation also. Now, what that means is that if they allow the building to be depreciated over 27.5 years. So if you buy a building for $27.5 million, the government will allow you to take $2.75 million of losses as a deduction every year for 27 years straight. A lot of times, and in most cases, this eliminates all or most of the current income, the income generated, which we talked about in point one. It allows you to wipe out any tax liability. Now that's huge. First, you get the cash income from this apartment building. Like I told you, the investors get paid cash. And then on top of that, you don't have to pay taxes on it. Huge. Accelerated depreciation. Now this is also known as a cost segregation study, and you add in bonus depreciation, it makes it even more compelling, but we're not gonna confound this with too many different things. But accelerated depreciation means that you can depreciate it much faster than 27.5 years. For example, cabinets, appliances, fixtures. All of these things have a smaller lifespan than 27.5 years. The government understands that, and they say, all right, you know what? These cabinets can be depreciated over 7 years instead of 27.5 years. So if those cabinets cost you $25,000 to put in, instead of dividing by 27 years, you can divide it by 7 years. So 30,000 divided by 7 means you get about 4,000 and change deduction extra per year. So that way you can actually have even more losses than the income gain. So what that means is that you have excess losses that you weren't able to capture from this property. That means that you get to actually use these passive losses against any passive gains. If you made money selling real estate, for example, on another property, you can put these losses against those gains. If you sell stock and you make a whole bunch of money with your stocks, you have to pay capital gains taxes on that. But because there's excess negative losses due to accelerated depreciation, you can offset some of those gains from your stock sale. And as a result, your tax liability is less. Again, don't quote me on this. Get all of the appropriate and prudent advice from your tax and legal professionals. But this is generally how depreciation works. So there you have it, guys. I hope this is compelling to you, because multifamily real estate, we think, is the greatest investment out there. We really do. And we've invested over $100 million over the last 4 years, which is proof that we actually believe what we say. If you're interested more in investing alongside us, I highly urge you to go to the website. It's in the description below. Book a call with me. Let's talk strategy. Let's talk specifically about your situation and how we can customize a wealth building strategy for you. This is a service at this point in time we're doing at absolutely no charge. So please take advantage of it if you are so inclined to start investing passively. And if you're not at the point that you want to invest, we still got lots for you too. Click on the very next video and we're going to talk about forced appreciation. And the very next video, we are going to dive deep into what forced appreciation is and how it can make us very wealthy. All right, guys, that's it for today. I hope you gained a ton of value from this. Let me know in the comments below. If you haven't already, please subscribe, and I will see you next video. Let's go. Thanks, guys. Thank you.